hello to all of you, and thank you for joining our webinar series. Refinitiv's been hosting, I think Victor said this is the 5th installment of the macroeconomic webinar series, where we've been looking at economic weakness and the impact on investments. Today in the series, we'll be specifically focusing on the real estate sector, greatly impacted by the shutdown of public spaces, retail, industrial, commercial, and with us to guide us through what we're seeing that impact on real estate is Will Robson, the Global Head of Real Estate Solutions with MSCI. Will explore the pre- and post-COVID real estate market trends to look at how the pandemic has impacted investment performance and what past experience might teach us about what's to come. So with no further delays, and now that the dog is quiet, I will hand it over to Will to guide us through the presentation. Thank you for joining us. Will, over to you.
And it's great. Thank you. It's great to be here. As Rachel said, I'm going to be talking to some of the data that we have from MSCI Real Estate. I'm going to first give a bit of context around what the markets we're looking at towards the end of 2019, before all the coronavirus impact started to hit, and then look at how private real estate markets have reacted to that in the first instance, and pull in a little bit of information from the listed markets too, and then think about how this might play out. So before I do that, I just wanted to say a little bit about what this data is and where it comes from. So our kind of main product area at MSCI Real Estate is providing risk and performance analytics for owners and managers of real estate portfolios. And so the data that we're looking at is the kind of result of that analytical process. So clients give us their property valuations, lots of detailed information about the cash flows and the characteristics of those properties, and we bundle all that together into risk reporting and performance reporting for those clients. But then we can also bring it all together and create market information products to allow people to understand what's going on in the markets, and that's what I'm going to present to you today. So if we start with a pre-COVID context, this is a simple chart using our global annual property index, which brings together the performance trends of around 25 markets around the world. And you can see the impact of the financial crisis there around 2008, 2009, that hit returns pretty hard across the markets. But since then, we've had 10 years of positive returns. You can notice 3 years, you've had this slight kind of deceleration in returns. The income return shown in the yellow bars has been stepping down, driven by yield compression, so a lot of capital flowing to real estate markets. But it's happened at a slowing rate, and so the rate of capital growth has been slowing down even before the coronavirus hit. And you can see the full year 2019 results by country here. So there was quite a range of returns from markets like Hungary, which is a very small market, but you had returns north of 15% there. The Netherlands is a pretty significant commercial market for global investors, has had a very strong few years of returns. But then at the other end of the scale, you got a market like the UK, which had already entered into negative territory. A lot of that was kind of just quite a long way through its cycle from the financial crisis, but then obviously Brexit has kind of weighed on sentiment around that market too. So you have the markets that make up the global index on the left-hand side, and then there's some other markets that don't yet make it into the global index because of reporting delays or the emerging nature of those markets. The coverage in terms of transparency doesn't make the grade to hit the global index quite yet. So you've got some markets like Thailand, China, and Malaysia there, with slightly higher returns than a lot of the markets in the global index. You'll notice the income returns are relatively high there, reflecting high yields for the more emerging markets. If we look at this other chart here, you've got the global index markets on the right-hand side, and by sector on the left-hand side, we're looking at net operating income yields against their historical ranges. And so that comment I made just now about yield compression driving a lot of the returns towards the end of the last cycle, you can see the effect of that here. With so much kind of quantitative easing and search for yield in real estate markets has driven yields to near record lows in most record lows in most markets and near to record lows in all markets around the world. So what that says as we approach what seems to be a turning point in the market, income returns are at record lows, and the potential for yield to kind of step up and cause negative capital growth is no doubt there. So it seems from the kind of deceleration of returns and what we'll see in the next few slides that we may be approaching a significant turning point. And we wrote a blog towards the end of talking about over time. And this chart, sorry, it's very small on this page, but you can read the blog on our website. The link is at the bottom of the page here. Looking at value growth move from a peak and through to a trough and then the summary. And the point of this slide isn't really to look at the details, it's just to illustrate how long it can take for private markets to correct over time. So you can see, for example, the bottom line in that chart is Ireland. And so to get from its pre-GFC peak to the took over 5 years. So it's a long and prolonged correction there, and it still is a long way from its pre-crisis peaks. And depending on when the correction was, what was driving it in terms of economic characteristics or investment characteristics, they can vary quite substantially in terms of the depth of the correction and how long it takes to recover. And that's something to bear in mind as we look at the data starting around private market valuations as we move through the coronavirus crisis. The other thing to note before we look at the most recent returns is this is again from the global index. So at the global aggregate level, we're looking at the relative performance of the sectors. So retail versus office, industrial and residential. And you can see through the global financial crisis, there was a pretty coordinated downturn where all the sectors basically moved together in unison. And it was, the clue is in the name, the financial crisis is a very financially driven correction rather than kind of fundamental economics or supply demand imbalances in the space markets that could differentiate across sectors. Again, there was a pretty coordinated recovery as well. But then over the last few years, you've seen the performances kind of diverge. So the red line at the top is industrial, and that started to outperform from about 2012, 2013. And we know the stories around online shopping. There has been a real tail of the industrial sector. But you'll notice on the other side of the coin, you've got the retail sector in the yellow line that has really taken a bit of a nosedive in the last 2 or 3 years. Which is obviously the other side of that coin. The retail sector, huge swathes of it have really suffered from the threat of online retailing, and we'll go into that in a little bit more detail too. So that sets us up for a discussion of what's happened so far in real estate valuations. One point I want to make first is compared to other asset classes like listed equities or fixed income, we don't enjoy the benefits of daily priced private real estate assets. Best we can offer in terms of frequency is actually in the UK market, where we have a monthly index, which is based off the performance of assets held by funds that are open to retail investors. So they need to give kind of regular marks to the units to price those units. But it does illustrate the kind of timing of the coronavirus impact. So you can see the blue line is the performance of on average, and you can see that dipped in the first quarter. It only hit in March. So the first 2 months of the quarter were reasonably good performance, and we saw negative performance come through in valuations in the final month in March. But it was only -2%. So that's pretty negligible when you compare that to listed markets, which I'll show you in a minute. But when you compare the sectors against each other, there was more of a dramatic impact to hotels and retail, which you would expect given the realities of social distancing and lockdown. It's generally impacted those sectors that have more of the trade and the value associated with the property through the interaction of customers with the businesses in the actual stores, rather than offices, for example, that tend to be more kind of corporate-based or back office functions. With retail has been in negative territory in the UK for quite some time already. And part of the reaction from valuers might be the build-up of an established sentiment around the issues facing the retail sector. COVID has really just accelerated a lot of those trends and brought them to fruition much more quickly. And so the comfort for valuers to be able to shift and react to sentiment in this retail is probably more apparent, which was operating relatively well until COVID. And it takes a bit more time to work through what the implications could be to value in the office sector. And that's the result of the nature of the private real estate market, where the marks on portfolios are done through valuations rather than the listed markets, where it's just an expression of buying and selling the units on shares on the companies. So we tend to see a more lagged response from private returns and somewhat more muted that takes a long time to come through. So if you compare that with the listed markets, these are the MSCI World IMI Core Real Estate Index on the left-hand side. So here it's an index of real estate companies where we're focusing in on those that are actually holding real estate for investment purposes rather than mortgage REITs or brokers. We're excluding kind of pure play developers from these indexes too. So it's giving you a sense of the performance of companies actually holding real estate. And you can see there was a pretty dramatic impact on pricing on the index there. So around the end of February, March, and then it's kind of traded sideways since then. On the right-hand side, you've got a sector breakdown, which is showing the similar kind of ranking that we saw in the UK monthly index, with hotels worst performing and retail similarly bad, offices somewhere in the middle, and then industrial performing not too badly, given the tailwinds around on retailing, which has become even more prevalent through the COVID crisis. This chart shows us an attempt by MSCI to kind of look for a hybrid solution to understand what's going on in real estate, so the underlying real estate, but giving you a more timely and less lagged and more frequent data points on the underlying real estate performance. So in this chart are the kind of performance of the core index that I just described over the month of March on the left-hand side of the chart, and the full first quarter on the right-hand side. The yellow bars are the performance from the monthly index. That's kind of underlying property valuations. So you've got a very big disconnect between the listed markets and the pure direct property markets. And then in the middle, we've got what we call the liquid real estate index, which is taking that core index of companies holding property, and then it performs like a minimum volatility tilt to that group of companies, and then holds those companies alongside fixed income securities to de-lever the REITs. So trying to find out what the drivers of performance of those real estate companies is driven by the underlying properties rather than the capital structure within the company. And that gives you something in between the two, which isn't kind of a forecast or a correct version of what's going on in the underlying property markets, but it gives you some sense of where transaction prices might be for real estate assets, kind of trying to account for the valuation smoothing and lags that are apparent with valuations. And here you can see that liquid index on the left-hand side, and to the unadulterated core index on the right-hand side. And you can see the drawdown is less pronounced for the liquid real estate index because we're taking out the leverage impact. But it's traded sideways more than the core index. You've seen a bit more of a recovery in recent weeks and months in the listed markets, as we have seen in some more broad across the equity markets. once you de-lever the REITs and take out some of the equity market beta, you get something more stable in the liquid real estate indexes there. There's a lot of content on this slide. I'm not going to go into the details. This again is from a blog that we published a few weeks ago, and it was in reaction to some of the Australian superannuation funds that had faced this problem where the pensioners, the beneficiaries of those superannuation funds, were allowed to draw capital out of their super funds to help them get through the crisis, basically. And so the superannuation funds needed to be able to mark their portfolios at what they thought was a reflective kind of transactable price for their private assets. And so they had to do an out-of-cycle adjustment to their valuations. So a superannuation fund might get their properties valued on a quarterly basis or on a 6-month basis, but they made an adjustment mid-cycle to control the liquidity processes. And so these adjustments were between 7 and 10%. And we were asking the question, okay, what does 7 or 10% movement in values look like compared to previous crises, the GFC or the 1990s recession? And how do they feel in terms of the contribution from underlying income growth in properties versus just a sentiment and a repricing movement? Because the GFC was entirely repricing. There was actually positive NOI growth through that period, as you can see from this table. Through the 1990s, you had a repricing impact, but also a fundamental income fall during that period. So think about different scenarios around this 10% valuation fall. If you thought that it was going to be driven by a significant income fall, like the 1990s, it would imply a very small uptick in yields, which feels quite light. So we're not making any forecast here, but we're just illustrating the point, being able to look to past data and the contributions to capital value growth or falls from the underlying drivers of cash flows and pricing. And all that detail is available in the data set to query. This goes back to the kind of global picture, but this time I'm looking at the trends on what we call the Global Property Fund Index. So this is looking at the annual index, which is our broadest set of data in terms of a sample of buildings. We're narrowing the set of properties we're looking at because we're looking for the quarterly valuations, and not all properties get valued that regularly. So this allows us to get a global picture, but on a more frequent basis. And so you'll notice the data goes up into 2020 now. So you can see a little bit more of the downward tick in the first quarter of 2020. UK leading the pack, and the European region actually holding up the best in the last year or two. And if you focus in a little bit more on the sectors within that sample of properties, you can see the movement from Q4 returns to Q1 2020 returns, so catching the first part of the coronavirus impact. So retail was already in negative territory and has got much worse, which is no surprise. All the sectors have stepped down in the returns, but offices, industrial and residential are still in positive territory on a quarter-on-quarter basis. And then the other sector is the other area that we've seen a big step down in returns. So reasonably positive returns at the end of 2019 and now into negative territory. And for most portfolios, the other sector is dominated by either leisure property or hotels, which are both sectors particularly impacted by social distancing and lockdown. Just to add to that, here we're going to individual country data. So these are the countries listed here are countries where there are quarterly indexes, property indexes. So that's Australia, Canada, Ireland, Netherlands, New Zealand, UK, and US. And generally, you're seeing a reasonably stable movements in returns. There's not a huge impact from the end of 2019 into the first quarter of 2020 yet. you see more of it in markets like the US and the UK, and in sectors like retail and hotel. In offices and industrial, it's much more muted at the moment. This is, again, there's a lot on this chart, and this is from a blog that we published just this week. So the point of this chart is to illustrate what's going on now versus the financial crisis. So it's a top set of charts, kind of making a similar point to what I said, referencing the global index. So you can see the relative weakness in retail in the red line compared to the other sectors, especially industrial in the green line. But what we've also noticed is back in the GFC, where you saw all the sectors kind of turning down in a similar fashion, you also saw a spike in the bottom charts. And the bottom charts are looking at the range of performance across individual assets within each of those segments. So what it's showing you, the GFC, for a lot of market segments, you saw the difference in performance between the best performing assets and the worst performing assets gap out through that turning point. And you are seeing some of that now, especially in the retail sector. So the red line here in the bottom back of charts is showing the interquartile range for the retail sector alone. And if you look at the UK in particular, where you've seen kind of the steepest decline in the retail sector's performance in aggregate, you can see a really pronounced spike up in the range of returns within the retail sector. So there's a very big difference between the best and the worst performing assets compared to history, and it's approaching the same kind of levels that we saw during the financial crisis. You can see the same kind of tick up in retail in Australia as well, to a lesser extent, and in the US. Not so much in the Netherlands, because the retail sector has been trending downwards, but it hasn't kind of gone into full negative territory yet, as it has done in the US and the UK. Moving on, here we're going back to the UK, but we're looking at fund level returns here rather than like property level returns. And so the UK has got a property fund index that we're able to split between different kinds of funds that are trying to achieve different kinds of objectives. And what it's showing is the broad trend in returns at the top of the charts. But you can see in the most recent time periods, the red line has started to dip down into negative territory, and that's representing the performance of specialist funds. So these are funds that are focused on particular segments. So there's the bottom left chart here shows you that the specialist funds have quite a lot of a retail focus, so it's not surprising that they would underperform. But the bottom right chart also shows you that they have far higher leverage levels than the other sectors. So approaching 30% leverage in the specialist funds, but all the other funds tend to be very lowly leveraged, almost nothing. And so that's another explanatory reason why those funds are kind of underperforming. In contrast to the specialist funds, the funds that are still in positive territory, so the green line at the top, are long income funds. So these are funds holding assets that have typically longer and more secure leases. So they represent a much more kind of fixed income type proposition with less equity risk in there. And be more, they would be more kind of resilient to any downturn typically, and so they've been performing reasonably well. This is, again, it's fund level data, but from the US, and it's just showing that the fund level performance has kind of tailed off a little bit in the top left-hand chart. The right-hand chart is showing the difference between the best performing funds and the worst performing funds. It's actually the comparison of the worst performing funds to the average. And in the financial crisis, you could see the worst funds were relatively even more bad compared to the average through the financial crisis. And that line is ticking down again now. The bottom chart is giving you some sense of what's causing that. So I won't go into the details of the chart, but basically we are able to show that those kind of funds are more exposed to the worst performing sectors. So retail is in the blue. Dots to the right hand side of the chart show that those kind of underperforming funds have more exposure, and the fact that they're at the bottom shows that they're the worst performing. Similarly, the orange dots at the top left of the chart, they have less exposure to those better performing industrial segments. And so that's kind of helped explain what's going on in this relative performance across funds. Here, skipping to Australia, we're back to performance, asset level performance data, but we're focusing in here on retail performance again. So we've got performance of the retail sector in the blue line on the left-hand side. And then all the thinner lines around that are the percentiles around it, describing the distribution around it. So you can see through the financial crisis that the spread of performance widened now and then narrowed again. And you can see it's dramatically widened out last data point for this year. The worst performing retail funds were very much worse compared to the average than they were even in the financial crisis. And you can see on the right-hand side, we're able to split between whether they're kind of prime, good quality, good location retail assets versus poorer quality. And the spread is wider for the poorer quality secondary retail assets as well. And then this slide, we're close to the end. This is hopping to Ireland for another retail story. You see, the Irish results have in the first quarter. They are the first index to publish every quarter, so they're pretty quick off the mark to get their assets all valued. And so many of the valuations may have been done before we even saw the worst impacts of the virus at the very end of March. Office, industrial, all were still in pretty positive territory. It was only really retail that was into negative territory. And that goes to the narrative that I was describing at the start of the presentation. On the right-hand side, though, we're able to look at the performance within the retail sector, but by slicing the retail sector up in different ways and comparing Q1 2020 in the red with Q4 2019 in the green. So the left-hand side of that chart shows the difference in performance trends by size for kind of high street shops. And you can see the middle bracket, kind of mid-size retail properties perform the worst. The next block of data is around the age of the property. So you can see in general, and even more so in March compared to December, the older properties were hit more in terms of performance than the newer properties. And then there's some micro locations within Dublin and Ireland showing the relative performance. So in this, we've got Henry Street was particularly badly hit compared to some of the other retail locations in Dublin. And then the final section is showing this distinction between lease length. So we're able to compare short leases versus long lease. And obviously in this environment, the less secure income has been hit harder than the longer income, as we saw in the UK with a distinction between long lease funds and regular funds. And this chart just draws that point out a bit more. So here is back to the UK again as an example of this trend. So you can see the performance of shorter leases against longer leases. So shorter leases in the blue and longer leases in the yellow. The faint grey dotted line is market rental value growth. So you see, as in the financial crisis, rental growth was significantly negative. It started to recover, get to sort of 0% growth, flat growth through 2011, 2012. And then you had a period of increasing growth through 13, 14, 15, and it started to tail off. And when you're in sort of negative growth periods, the longer leases will tend to outperform because you're protected against rents falling. Whereas once you enter into a growth phase, in the middle of this chart, the blue line starts to outperform. So the shorter leases give you less security, but as rents are rising, you're more able to capture those rental increases. But then as the market's slowing down towards the end of this time series, and particularly as we enter into the COVID crisis, where there's a lot of stress on tenants, you can just about see the long leases starting to outperform again. And perhaps that gap will open out again as we move forward through the coming quarters. The difference now to what we may have seen in the past is, in general, long leases give you more security, but in such an extreme environment where previously good tenants, secure tenants, are under extreme stress in terms of their profit margins and their ability to pay rent, just because you got a long lease to a reasonable covenant in historical sense might protect you against kind of failure of those tenants. And so it'll be interesting to see just how much protection the long leases do give investors through the coming months and quarters. And with that, it finishes the content. It's just that one slide here to mention there's a lot of content being produced by our research teams within real estate, but also across asset classes, in reference to coronavirus directly, but also bringing together multi-asset class views with real estate views. So all these links will give you a different flavor search that's available from MSCI. And with that, I'll hand to Victor.
Hey, Victor, while you're getting set up, just one comment for the audience. If you have any questions for Will, there's a Q&A panel in the side of your screen. Feel free to submit those questions now. And while Victor's going through the Refinitiv offering, I will review and we'll circle back with Will to ask those questions at the end. Victor, are you good to go?
Yeah,
there you
yeah, I'm good to go. Hi, everyone. This is Victor again. Thanks for joining us. And Rob, thank you for all that. Today, I'm actually going to jump into DataStream to showcase how you can actually find some of the MSCI real estate information that will presented. For those who are new to DataStream, DataStream is one of our most powerful offerings and it's considered the world's largest historical database. It's very enriched with cross-asset content, but it's really well known for its economic data set. It's leveraged in the industry by asset managers, economists, universities, and government agencies. With access to all that content, it also has very high, powerful analytical tools, as well as an integration completely with Microsoft Office. So you can actually take the data, do your analytical work, and then export it refreshable to Excel, PowerPoint, and Word. With those capabilities, there's also a very robust charting application that allows you to create graphics, manage them in a library, share them, and export them refreshable to various Microsoft Office locations or even websites. All these contents are available through the desktop called Icon DataStream, which I'll go over in more detail shortly, as well as different types of API data feeds. We're continuously trying to improve and expand, and one of the things that we recently added is our China content. We've sourced about 130 reputable sources to become the industry leader in China financial as well as economic content, and I'll go more in detail on that subset of content in a short bit. To access all this content, I'm currently showcasing what's called the DataStream Navigator. It's just a content searching tool. Here, you'll have access to 39 million time series, individual series. And if you pair that with different measures for those series like price, market cap, total return, that 39 million extends to 400 million series. It's very easy to use, and it's two specific ways to use it. You can natural language type in to the search key, or what I have displayed here is using the Explorer category. I'm just jumping to the Explorer button on the top left to jump into economics, and then drilling down directly into the MSCI content that Will represented today. By hovering over any of these series, a little pop-up showcases a quick chart and the complete profile of that series update, history, even a link to that source website. After selecting the series, you can take that into Excel or power it directly into DataStream charting. Here, I recreated one of the slides in Will's presentation earlier, taking in the income returns, capital returns, and total returns across this specific time series, setting in the title as well as the color. On the top left are a number of analytical tools, and quickly to the right, highlighted in yellow, are all the integrations to Microsoft Office. And if you're managing any social media or websites, you can also push that out to those various locations. It's all refreshable. If I make a change here, it will reflect in those publications. An example of an export is right in this slide on the right, where I exported a creation of their evaluation chart for REITs, retail, and the S&P 500. I'll come back more on details on that content set. So in addition to the MSCI content, DataStream is really well known for a lot of the macro or deep macro and economic content. Something that is highly leveraged by economists and strategists is our international comparable economics, covering 157 nations and 51 key indicators. What makes this unique is that we standardize this information so that when you look at US versus China for any specific time period or any other country in this set, you're getting an apples to apples comparison. We've done the conversion methodology as well as seasonality for these. So again, apples to apples. While the comparables host the historical information of these key indicators, the Reuters poll, really well regarded in the industry, is a forecast of these key indicators. We're polling or surveying economists across multiple banks and then drawing in and aggregating the information to create what's called a median, also presenting the high-low range. And once the economic event occurs, we'll capture the actual and showcase the deviation versus the poll or the estimate. In parallel to that is something called IBIS Global Aggregates, where the polls are providing forecasts for economic content. The IBIS Global Aggregates are providing forecasts and valuation metrics for different industries. On the right is a perfect example of a chart showcasing the retail REITs industry versus the retail sales or stores sector versus the S&P 500. And this is their NTM or next 12-month PE ratio, showcasing the evolution of estimates over time by these analysts. In addition to that, we also have a proprietary data set called DataStream Indices, where we aggregate country-level content and try to showcase or capture about 85% of the market cap within each country. In that fashion, you can compare apples to apples across different multiples such as EV to EBITDA, net debt. Again, you have confidence because this is standardized and using the same methodology. We're also collecting a number of sources or government agencies such as the Bureau of Economic Analysis, U.S. Consensus. I highly recommend those specific sources to drill down to real estate content such as like vacancy, lease, lengths. Some of that content is available in those sources as well. In addition to that, we also have fixed income indices as well as partnerships just like MSCI with other data providers, IMF, Oxford Economics, as well as forecasted firms like Consensus Economics and Markets. So coming back to the China data and some of the other offerings within ICON, I just want to expand a little bit more on China and why it's very important to some of the topics that Will spoke about and some of the current top-of-mind conversations. Here is, again, the navigator showcasing the depth of China economic content. This is going beyond just China GDP and unemployment rate or manufacturing data. We're drilling down. If you look at the middle column, it shows directly the different provinces going from Beijing, Shanghai, even Hubei, where it's the ground zero of COVID. A lot of economists and strategists are using this as a case scenario to determine where the laggers and leaders are in these industries and hoping to use this and determine where other countries and other regions will rebound. While DataStream hosts the historical economic content, ICON has real-time economic monitor covering over 150 nations and capturing a majority of their economic indicator releases. Here, I'm showcasing the entire content set. In addition to that, if you want to drill down more into a specific industry like real estate in Europe or in North America, Icon also has what's called an industry app. Here, you can select the specific industry and the region, and we aggregate a lot of content in a single view. Here we have the equity indices on the top left. To the right are key KPIs or key performance indicators for that sector and that region, and also aggregated news, research, and filing content. And one of the other initiatives that we've actually been able to do is what's called a Belt and Road Initiative, which is considered the largest infrastructure project started by China. It started in China and now spans over 72 nations. And this is the Icon interactive map capturing these specific infrastructure projects. You'll have full details from the purpose of these projects to project progress, financing, as well as the participants. A lot of our clients are using this to look at tourism, real estate investments, trends in those specific regions. With that, I'll just jump back into the data stream grid or chart or table showcasing the complete offering of data stream, 39 million individual series, and we're just touching the tip of the iceberg here. If you have any questions, please feel to reach out to us. This content is available through data streams, Icon Data Stream Desktop, or a variation of API data feeds. With that, I'll shoot it back to Rachel and Rachel and Will for the Q&A.
Great, thanks, Victor. Just as a reminder, you can type your questions to either Will or Victor in the Q&A box, and I am monitoring that, and we'll go through those. If we don't get to your questions, we will circle back with you after the call via email. Will, I just want to start off with the kind of a high-level sector question before getting into some more of the subsector details, which I think are really interesting. Early on, you showed the dip in the global financial crisis and then the recovery period afterwards. Do you expect the same sort of pattern in terms of recovery over what time frame, and what may influence how fast the overall real estate sector rebounds?
I think it's obviously it's a question on everybody's lips. It really depends on a number of factors. So the financial crisis was initially driven by a very kind of financial kind of stress scenario, and less, at least initially, by kind of a significant economic impact. It kind of came finance first and then economics. Here it's really interesting because it's kind of come out of a bolt out of the blue, and there's been a real kind of immediate economic impact. And so you've seen that in the way that income's really tanked straight away. There's tons of really just not receiving rent from the tenants. Normally we see price correct sooner than we see kind of economic growth feed into rental levels, and then those feed through into leases. So often real estate is kind of protected to some way because of the lease structure. Here, that lease structure hasn't really protected many of the certain sectors of the retail market and leisure. So I think you've seen more of a dramatic economic impact, and because there's been so much government stimulus in the financial markets, but also kind of directly to employees that are being furloughed and supported, like their wages being paid by the government, that is typically still going on, and it's really hard to understand now, once that starts to taper off, like how many people actually have jobs to go to and what the broader economic impact will be. So from a pure finance point of view, I don't think you've seen like listed real estate companies kind of get hit hard, but then somewhat of a recovery. Private valuations haven't really moved very far. But you saw that in the financial crisis at the very start. It took a while for things to kind of get moving, and then move very quickly. So it's hard to know how far it'll fall. It feels like there's going to be much longer economic impact from this crisis, but who knows? I suppose a lot of it depends on the virus, to what extent we have the first wave, and then kind of people get gradually back to normal. if we second wave or multiple waves, or kind of just virus awareness becomes ingrained in people's psyches, then it could have some pretty long-lasting impacts. Like beyond the sort of high level, like I think the kind of structural impacts that we're having before the COVID crisis, we talked about industrial and retail before. I think COVID has really just accelerated a lot of what's happened to retail, and that could have very long-lasting implications. And working out which retail assets are still relevant to society these days and which aren't, and what they end up becoming is going to take some time.
Yeah, so it sounds like, and I think you had a couple charts where perhaps MSCI was trying to tackle some of that data lag. The challenge being, the valuations of private assets versus the liquid markets. Before we even start to talk about when are we going to come back, the question is, are we really seeing the true bottom? And then we can start to talk about and think about a return. And based on what you're saying, it sounds like different sectors may see that differently, from retail to commercial and industrial. Very helpful.
Exactly.
So just as we go from sort of high level, let's talk more about those subsectors where it seems like all of really the nuance lies, because it's pretty varied across some of the areas you spoke about. I'll take one from someone at CBRE that asked, what is MSCI's long-term outlook on the co-working office space industry?
Okay, so before I say anything, I must say that this isn't kind of MSCI's house view. We don't really forecast things, but if you think about what's happening, just what we're doing right now, having a virtual webinar rather than a live event, that's happening all over the world, and everybody is experiencing kind of the work from home environment. I think lots of companies are dealing with the short-term stresses of how they maintain productivity in the workforce, but I think in the main, they're quite surprised at how productive their workforces are, and quite nicely surprised. And a lot of them have made public statements around reassessments of their corporate property portfolios and how much office space they actually need. At the same time, you've got people quite enjoying working from home in some respects, but also with not less than ideal workspaces at home, kind of missing the camaraderie that they have at the office and the ability to collaborate. I think before the crisis, there was a discussion around kind of co-working and its disruptive impact on the office sector more generally. And so the whole WeWork story, and there are other office providers and WeWork, but that was definitely a big topic of discussion before the crisis. Obviously, co-working has a lot of issues with social distancing and kind of people being in the same space, so it has suffered as much as any other sectors in the short term. But if you think longer term, I think corporate occupiers will be much more deliberate thinking about what functions and what people, what activities they do need to happen in an office and what could happen at home, which things are better off than at home versus the office. It might not be at home as well. It might be just another location of the employee's choice. So when it comes to co-working, it might be that kind of the core corporate office space required by a corporate may be reduced, and they may want to have a more flexible solution. So I can definitely see a scenario where co-working does quite well. It may be in different locations to what people had thought of in the past. So there's been a real phase within major office markets. But if people quite like living a bit further away from the city and not having to commute in every day, maybe there's a market for co-working spaces in more suburban locations. I think a lot of companies' satellite offices, so a big corporate that maybe have headquarters with hundreds of people in, but then lots of smaller offices with 10 or 20 people in, they might rethink the model for those smaller offices and go to a more flexible solution for that. I think the broader impact of this will be, it's hard to understand what the the demand for the aggregate amount of space will be, whether it goes up or down as a result of this. I think the nature of the space that people will want will change. So I think the days of just having rows and rows of desks for people to perform their tasks chat next to each other probably go away, because you can do a lot of that from or another location. I think there'll be a much more focus on people interacting together in office spaces. So companies providing a space for their employees to collaborate and work together. So that might mean space in offices and less desk space, funkier collaboration spaces, a mix between online and physical, so that you can have a team of people collaborating in a space with people dialing in from outside and having really effective meetings that way. So yeah, I think there'll be lots of changes, but working out exactly what the impact would be on the amount of space demanded is pretty difficult.
Yes, I think something that will, impact most of us personally, as we're all virtual for the time being. But for instance, Refinitive's office is in Times Square. MSCI has a building downtown. Keeping an eye on the strategy for office space there for sure impacts many of us. I'm going to switch gears a little bit. A question came through specific to the Saudi Arabian real estate market. So we've got a question around, how do you expect the Saudi Arabian real estate market to shape up in terms of international demand?
Saudi Arabia is a difficult market for us to comment on, because we don't actually have it for that market. As I said, the nature of our data, it comes from the portfolios of large institutional investors, and you tend to find those are dominated by exposures to very well-developed markets and transparent markets like the US, UK, Europe, Australia, those kind of markets. There's increasing exposure to more emerging markets, but markets like Saudi Arabia typically have less exposure, less ownership from large international institutional investors. So we've got less to say specifically on the Saudi Arabian market, but I think they'll be suffering from the same kinds of broad trends across sectors that any other country would be. On top of that, typically in a crisis, investors tend to retreat to kind of their core holdings or safer holdings, whether it's flight to quality or just more stability. You tend to find kind of exposures to emerging markets or frontier markets tend to kind of reduce, and you get more exposure to developing markets. So maybe that plays into the equation for Saudi Arabia.
Great, thanks, Will. I guess we probably have time for one more question, which I'll bring it back to some of the subsector or sector analysis you did. We talked about this, first finding the bottom and then the speed of recovery. It seems like retail is obviously the most dramatically impacted, which seems to be a trend that started before COVID. And it sounds like it's caused by more demand-supply dynamics rather than just only COVID, which seems to have exacerbated the situation. When it comes to retail, what would the retail sector need to do, or how do you see the retail sector coming back if you do it all? What would spur a rebound, I guess, in retail, given that it's more demand-supply potential changes than COVID?
Mm-hmm. I think with anything, there's a price for anything. The thing with retail, the financial crisis, retail tended to be a very large part of institutional, and to have stable performance compared to definitely this sector, more volatile rental profile and therefore returns profile. So it's kind of like an anchor to people's portfolios, but been a pretty significant change online retailing. But that hasn't hit the whole of the retail sector the same. I hadn't gone into a lot of detail in this presentation, but we can slice the retail sector up into various subsectors, comparing large malls with kind of neighborhood malls and malls. We can also look to our leasing data to dig through into not just what the property is called, whether it's a mall, but comparing one mall that may have lots of restaurants and coffee and leisure facilities, compared to another mall that would be a suburban kind of just selling commodity kind of fashion or something that's not very exciting. And once you start to look through the tenant exposure, you can see a real differential in performance. Before COVID, at least, more rental exposure to experiential tenants. So whether that was food and beverage or leisure, better. Those that were more focused on kind of fashion retail, which is more easily accessible online, did bully. And then if you add on exposure to convenience retail, so supermarket food shopping, that kind of thing, those tended to do as well, because it's something that's kind of, at least in the US, online food shopping hasn't had the same kind of penetration that it's had in the UK. Now, through COVID, I think we're seeing a lot of the convenience retailers were exempt from lockdown, so supermarkets stayed open because people need to eat. So I think you'll see them do well. But longer term, also what you've seen is much more investment from the retailers in their online offer. And so convenience sectors, there's been a online deliveries and for online shopping. So that might see kind of a bit more of an accelerated trend to the online model in those that were previously kind of shielded from the online threat. Once we get through COVID and lockdown and social distancing, I think you'll see the benefits of experiential tenants and making places somewhere that people want to go to other than for the reason to buy something. And I think longer term, that's the only reason, that's the only way that you're going to be able to defend, is provide a reason to go to these places and spend time there and spend money. And whether that's kind of looking at things, online purchase, because you've used it as a showroom, it may be irrelevant. As long as the real estate industry can demonstrate to a tenant that they're able to generate sales wherever that might come from, but because of the property, that's the kind that you need to be able to demonstrate the value of that property exposure.
Yep, that makes a lot of sense. And you can probably think of a few retailers who have already started to pick up on that trend, integrating, experiences while you're shopping and a reason to go to the retail location rather than shop online.
Service and experience and advice.
Exactly. And actually, you had a couple of examples of some of that retail data, I believe, cut a few different ways: size, age, location, lease length. I don't know if that was specific to retail, but talking about quality of the space and so on as impacting, performance as well. So it sounds like for our listeners, there's multiple ways to dig into some of that data to really understand the impact much more based on all of those different criteria.
Yeah, and it's a big area of research for us to.
For you? For MSCI?
Yeah.
Sorry, there's a delay.
To dig into that detail more. So.
Good. We are at the top of the hour. There's a few more questions we didn't get to, but we will absolutely follow up with those who submitted the questions through the chat. So thank you for asking them, and we will absolutely come back to you on them. I just want to thank Will Robson, Global Head of Real Estate Solutions with MSCI, which was a very interesting presentation, very relevant for all of us, and I think left us in suspense to keep an eye on the data to see what's to come, and multiple different avenues to do further research into different sector impacts. So thank you, Will, for leading us through this presentation. Thank you all for attending this installment of our series.